Andrew Schwartz here. I'm one of the managing directors at Earned. So every business has overhead, and those businesses that do the most to manage their overhead put themselves in a position to maximize the profitability from their businesses. Let's say you have a dental practice that collects about $1 million per year. If you're able to shave 2% of your collections off your overhead costs, that puts an extra $20,000 of profit into your pocket. If you're able to shave 10% of your practice collections off your overhead costs, that puts an extra $100,000 of profit into your pocket. What we're talking about is what we call non-doctor overhead. So to figure out non-doctor overhead, we take the associate's salary, payroll taxes, and benefits, and we move that from the non-doctor overhead and we move it to cost of sales actually on the profit and loss statement. And then we take the owner's salary, payroll tax, and benefits. We also take some of the discretionary expenses such as their automobile expense, their home office reimbursement if they do the Augusta rule, if they have their family members being paid through the practice but not working at the practice. We take all that out of the non-doctor overhead as well. And then we also remove the EBITDA things, earnings before interest, taxes, depreciation, and amortization. We take all that out of non-doctor overhead. So when we're left with non-doctor overhead, we have something that we can compare from practice to practice. It makes it very easy for our clients to know exactly what they're spending for overhead as a percentage of collections and how they're doing compared to their peer group. Each year we work with just over 300 dental practices in New England, mostly within the greater Boston area. As a matter of fact, we work with about 10% of the non-corporate owned dental practices in the Boston area. So every spring, we collect all this data from our dental practice owners, and we do so we can help our dental practice clients figure out how they're doing compared to similar practices. Every June, we mail them their annual benchmarking report, and it includes a section on how their overhead costs compare to their peer group. Another thing that we do when we do this analysis is we're always trying to figure out what drives profitability, what drives revenue, all things like that. And over the years, one of the things that we realize is there's an extremely high correlation between the revenue of a practice, the collections of a practice, and their non-doctor overhead. As a matter of fact, every year when we compare non-doctor overhead with collections, the correlation comes in at about 94 or 95%. So what this means is the collections of a practice is a 90 or 95% predictor of how much non-doctor overhead that practice would have. So when I saw that originally, my initial thought, which isn't correct, but my initial thought was, well, if revenue is a 95% predictor of overhead, then does it really matter what any practice owner spends? But boy, was I wrong. A couple of summers ago, we had a few Bentley University interns come to my office, and they spent the whole summer going through all this data we collected for the last 4 or 5 years to try to figure out what really drove EBITDA. We were trying to figure out what drove the true profitability of a practice. And to do that, we had to figure out EBITDA, which factors in what it would cost to pay an associate to do the work that the owner of the practice was doing. So we refigured what the owner would earn as a salary, which let us figure out what the true profitability of the practice was. And what we realized when they went through this analysis was that the biggest driver, the most important factor when determining EBITDA, true profit per patient who came in at least for one visit during the prior year, was overhead percentage. As the non-doctor overhead as a percentage of collections increased, the true profitability per patient decreased. So keeping an eye on overhead, as it turns out, is extremely important to maximizing the profitability of your practice. If you want to maximize the profitability per patient, which who wouldn't? That's part of the equation. So we have all this data. Last year, we divided our practices into 3 buckets. So the smaller practices were practices that collected less than $1 million. Mid-sized practices for our pool of practices collected between $1 million and $1.5 million. And the larger practices that we deal with, because most of our practices, it's one owner, one location still. were practices that collected more than $1.5 million. We'd love to help you figure out how the overhead of your practice compares with your peer group. And to do so, Earned has specialists who can help you with that. I just want to end with a quick story. So every spring we put together our benchmarking report, and during the summer meetings we have with our clients, we go over the benchmarking reports. And included in the report is their non-doctor overhead as compared to their peer group. So I was going over the report with one of my clients, and we looked at the non-doctor overhead page, and that page breaks down the non-doctor overhead into 5 or 6 categories. So we have staff expenses, facility expenses, dental supplies, lab, advertising, and everything else. Everything else is IT, professional fees, insurances, things like that. On that page of the report, it shows the collections, and it shows these 6 categories of expenses compared to the percentages of their peer group. So this client, everything was right in line except his staff expenses were high. The average staff expenses that year for a dental practice his size was 28% of collection. So the similar size practice that year spent 28% of the money collected on not the associate and not the owner, but for the front desk staff, the assistants and the hygienists for their payroll taxes, and their benefits. So the average that year was about 28%. This client came in at 38% of collections. So I was going to start to point that out to him, and he's really smart. So he saw that the staff expenses were high, and he basically said, yes, I know my staff expenses are high, but I purposely have too many people. I like paying them a high salary, and I'm pretty conservative with my dentistry, so my production isn't quite as high as another dentist would be. And you want to know something, Andrew? I'm not going to do anything about it. So I thought to myself, well, you have $1 million practice, you're spending an extra $100,000 on staff expenses than your peer group, but if there's nothing you're going to do about it, at least you know the cost that you're incurring to continue to employ the current staffing levels that he has. So it's information like this that really helps practice owners get a handle of their overhead costs. We set up our clients' QuickBooks so they, at any time, they can create a report to see how the non-overhead costs are going, and it really helps them manage their practice, their financial aspects of their practice. So as I said, there are advisors at Earned who are very knowledgeable with helping dental practice owners keep an eye on things like this. So we'd like to help you out. And if you have any questions, I'm around too. It's Andrew Schwartz. Thank you.